Hi, it's Nishi, and today's video, what I want to talk about is just what are the pros and cons of putting property into a limited company. So there's a lot of people out there talking about the benefits of using an SPV, special purpose vehicle. By the way, before I go into this, so remember to check out our website, naccounting.co.uk, and we've got some great content on there to help you grow and scale your own business and actually get your finances and taxes in the best position. So why are SPVs so great? Why does everyone talk about them? Well, I'm going to go into the pros and I'll talk about the cons anyway, or when it's not appropriate. But okay, pros. Well, firstly, like if you're paying tax at 40%, because you're a high rate taxpayer, then by putting it into a company, you're getting your tax rate down to like 19%. So you do end up paying less tax through the company. And one of the other main advantages of it as well is essentially if you've got like another business where you've been running it and trading out of it and it's built up profits and surpluses, and you don't want to take those profits out of the business yourself because you'll pay really high dividend taxes. What you can actually do is you can either create a holding company to own your SPV and your main trading company and then move money up to the holding company and back down to the SPV, or you can just loan it directly from your trading company to your SPV. By doing that, actually, you're avoiding all those dividend taxes because intercompany dividends and loans are tax free. So those are the two main advantages. It essentially lowers your tax rate if you're a higher rate taxpayer, and it means you can transfer money from one entity where you've got loads that's built up without having to take it out personally and pay the personal taxes into another entity which really needs it. So those are really the benefits of going down the SPV route. Let's talk about some of the drawbacks I've seen. Well, I don't know if it's as prevalent anymore, but it used to be the case that actually it was harder to get a mortgage for an SPV and you'd pay a higher rate. One of the other drawbacks actually a lot of people don't always talk about though is essentially you can, with an SPV though, you if you sell the property one day, all the profits from that sale are still stuck within that company. So at that point, you either have to have that company wound down or you have to then withdraw those profits as a dividend. So what happens is when you sell and you've got capital gain, you're paying tax twice, mainly partly on the gain on the profit you made on that property, but then you're also paying tax to get that money out of that company. So on the other side, when you are making that gain, there is a challenge. A lot of people say that's not an issue because they're just going to pass that rental company down to their children, who'll probably pass it down to their children. So fine, but it's worth pointing out. But I think it's worth saying at this point is one of the most inappropriate times I see people utilizing limited companies is for properties like the SPV idea is people who have barely got any other income, who are barely using up any of their basic rate of tax or their personal allowance, and then they're trying to put properties into a SPV anyway. And like if you're in the basic rate or you're in your personal allowance and you use an SPV, you're guaranteeing that you're going to pay 19% tax on that at that point. But your tax bill, if you didn't have any other income, might be zero personally. Or if you were basic rate taxpayer, it might be that you're taxed at 20%, and fine, you do lose your mortgage interest relief at 20%, but you also gain the credit to replace it at 20%. So overall, you're not really worse off. So quite often, if someone's in the basic rate of tax and they've already got savings which they don't have to get out of another entity to put down as a deposit, then a limited company owning the property that they want to buy isn't always the best route. And this is just one thing I wanted to cover. And also, I know there's one of the challenges is if you've already got a property in your personal name, a rental property, and you want to put it into a limited company, is it can trigger stamp duty and capital gains tax when you do the transfer. And I've heard of so-called experts out there saying actually you can avoid that by putting it into some kind of partnership and then transferring it into a limited company. I personally don't. It sounds like a tax avoidance scheme to me, and you got to be very wary of it. But I'm not fully aware of what they're proposing. But it did seem very it seemed too good to be true. And there are a lot of people that get caught out by tax avoidance schemes. So definitely worth having a think about that. But in general, having a property, your rental property in a limited company or an SPV isn't always the right answer, and you've still got to talk to your accountant and ask the right questions before you go down that route. So Hopefully you found this video useful. Remember, if you go to our website, you can book a call with me, and if you want to discuss any of this in relation to your own business, and I'll see you in the next video.